APAC's asset and wealth management industry recently saw fund managers across the region prepare for a new Trump presidency, Singapore steal a march on Hong Kong to become a digital asset centre, Hong Kong alter its capital investment entrance scheme requirements, and China reportedly again ask investors to reduce stock selling. Let's take a deeper look at these, as well as other headlines and developments. Over to Singapore. Paragon Capital Management, a Singapore-based asset manager, has opened its first overseas office in Hong Kong, seeking to grab a share of the wealthy individuals in the wealth centre. Paragon, with assets under management of 1.2 billion Singapore dollars, has received relevant licenses from the SFC, Hong Kong Security and Futures Regulator, allowing it to proffer a wider range of services to clients in Greater China, with the team in Hong Kong seen as a bridge connecting clients across North Asia and Southeast Asia. Paragon serves as an external asset manager and offers clients a range of public and private market products. Hong Kong lost its status as APAC's top-ranked financial centre to Singapore during the COVID-19 pandemic and reclaimed the spot when the rankings were released in September 2024. Its asset and wealth management industry grew 2% in 2023 to reach $3.99 trillion US. Several other FMCs have established themselves in the SAR recently, a sign that its efforts to woo managers across the globe are bearing fruit. Next up, Singapore's efforts to establish itself as a digital asset centre appear to be gaining traction and bearing fruit, while regional rival Hong Kong seems to be losing ground in their eternal struggle. Over 2024, Singapore provided 13 crypto licenses, more than double the amount issued in 2023. Hong Kong's licensing regime has progressed at a slower pace, with a total 7 platforms given regulatory approval, 4 of which came on December 18, 2024. Several prominent digital asset exchanges withdrew their applications due to a lack of progress and other reasons. While both centres have been keen to establish themselves as digital asset hubs, their respective progress has been uneven, with Hong Kong's regulatory regime seen as more restrictive in a number of ways that matter, which includes asset custody and token listing and delisting. This restrictiveness is seen by some as having tipped the balance in Singapore's favour. While approvals in Hong Kong have been slower than expected, regulators have signalled their intentions to provide more exchanges with regulatory approval by the end of 2025. Further, Hong Kong bars trading of alternative coins and generally allows only for the most liquid cryptocurrencies, like Bitcoin and Ethereum, to be available on authorized exchanges. While several spot Bitcoin and Ethereum ETFs were launched in Hong Kong in April 2024, they were not as enthusiastically received as similar products launched in the USA following the SEC's decision to allow such products to launch there. Hong Kong's products have accumulated assets under management of circa $500 million US since inception, compared to the $120 billion US seen by those in the USA. The role of China on the SAR is also an area of consideration for firms looking to establish or expand their APAC presence. While Beijing has banned cryptocurrency trading, though the effectiveness of this is debatable, it is allowing Hong Kong, for the moment, to serve as its crypto and digital asset centre. This arrangement is seen by some as giving the SAR a different risk profile compared to other centres like Singapore, which is seen as a safe long-term choice as a regional hub. Both centres are progressing with aspects like fund tokenization and the application of blockchain technology in financial institutions. The MAS, Singapore's financial regulator and central bank, recently announced plans to support and develop the commercialization of asset tokenization via Project Guardian and Global Layer 1, and it has seen several tokenized funds launched. Hong Kong recently saw the sale of 6 billion Hong Kong dollars in digital green bonds via the tokenization platform of HSBC, a British financial institution with historical ties to Hong Kong and China, and launched Project Ensemble in March 2024, which sought to support the development of a wholesale CBDC and assist in developing the tokenization market in the SAR via innovative financial infrastructure. Whether Singapore continues to extend its lead, or if Hong Kong recovers some lost ground, will be interesting to see. Up next, as waiting times for fund management licenses increase in Singapore, some are shifting their focus to Hong Kong, with several firms withdrawing their applications from the Lion City and refocusing their efforts on the Special Administrative Region, as the regulators there were seen to be more predictable. While the MAS estimates a 6-month wait for licenses to be granted on an in-principle basis, several applications have reported the process taking up to 12 months for such approval, with the average time settling around 6 to 8 months. Some industry participants noted that around 8 years ago, the process would be completed in 3 months, though they concede there are much higher numbers of applicants to Singapore now than previously. Data shared by the MAS indicates that 112 fund managers were approved in 2023 with a median time of 6.2 months, 1 month longer than the data available for 2022, which in turn was an increase on 2021's median time of 3.8 months. The recent increase in application time is attributed to greater scrutiny, with stricter requirements on company personnel and shareholders, such as the need for experienced management personnel compared to inexperienced shareholders. Industry observers note that times have increased since the 3 billion Singapore dollar money laundering scandal in Singapore, which saw 10 Chinese nationals arrested, and the tightening of the single family office application process. This resulted in enhanced anti-money laundering and know your client requirements, as well as Singapore being more discerning around which firms were allowed to establish themselves in the city-state. Singapore's requirements for FMCs were already higher than Hong Kong's, with licensed firms needing at least 2 directors compared to 1, and a minimum capital of 250,000 Singapore dollars, circa 182,000 US dollars, compared to 120,000 Hong Kong dollars, circa 15,000 US dollars. As of third quarter 2024, Hong Kong has seen 76 new companies provided with the requisite license, an increase from the 58 seen across all of 2023. The number of licensed financial professionals also increased, superseding the previous record seen in January 2022. Despite this, FMCs still have geopolitical concerns with regards to operating in Hong Kong, and the jury is still out on which city will be the preferred destination to set up shop over the course of 2025. So, that is this episode's section. Check out our profile for this episode's other sections, and let us know in the comments if there was an important development that you think we missed and should have been included. Many thanks for watching. Hope to see you next time.